Today we're going to be talking about Chapter 12, which covers cost allocations. And this is a complex topic because it's not as intuitive, I think, as some other topics we talk about in managerial accounting. So it may be challenging for some folks to grasp all of this the first time around. But don't worry about it, because I'm sure you can understand that it's just a matter of working through enough examples and understanding enough of the theory behind the application, and then no doubt in my mind that it'll fall into place for you. So don't be frustrated as we move through it. It is difficult. And so once we're done with this chapter, what we want to have been able to do is to describe the general framework for cost allocations, understand how to allocate variable and fixed cost of service departments to other organizational units, and we want to be able to use the direct and step-down methods to allocate service department costs to user departments. We also want to be able to allocate costs from producing departments to products or services using either the traditional or the ABC approaches, which we'll talk about. We want to allocate costs associated with customer actions to customers. We want to understand how to allocate central corporate costs of an organization, sometimes referred to as general and administrative costs. And we want to understand how to allocate joint costs to products using physical units or relative sales value methods. And so cost allocation methods are an important part of a company's cost accounting systems, which are really, as we talked earlier, the techniques it uses to determine the cost of a product, service, or customer, or other cost objective. And then why are these allocations important? And it's because less than half of a company's operating costs can be traced directly to products and services. The rest of the company's costs must either be allocated using a cost allocation base or left unallocated. So we use cost allocation to provide us with a true picture of what it's costing us to manufacture the product or provide the service, knowing that part of the costs that go into either the manufacture or a service are considered direct, and we talked about direct versus indirect, and then the remaining costs are these indirects that have to be allocated on some basis. And we want that basis, obviously, to be fair and equitable to the managers involved for performance evaluation and compensation purposes. So after developing a general framework for cost allocation, we will take a careful look at the development and use of allocation systems. We'll use the framework in Exhibit 12-1 to show how cost allocation fits into the overall cost accounting system. Each of the arrows in 12-1 represents an assignment of some cost to a cost objective. We show four types of cost objectives, either service departments, producing departments, products or services, and customers. The cost accounting system first accumulates costs and assigns them to organizational units. We will call each unit a department. There are two types of departments: producing departments, where employees work on the organization's product and services, or service departments, which exist only to support other departments or customers. And so we can trace direct cost to each department. In contrast, we have to allocate direct costs, such as rent for facilities used by more than one department. Many companies develop allocation methods to assign service department costs to the producing department. And so what we're saying here is that if I have a manufacturing department, I'm able to trace the direct cost. So it's, suppose I'm manufacturing some product and I use raw material A and raw material B and raw material C. Well, a direct cost is the cost of raw material A that I can trace directly, the usage of which I can trace directly to my manufacturing department. Raw material B, I can trace directly to my manufacturing department, and the same with raw material C. But perhaps I have the IT department that has to support that manufacturing department also. Well, the IT department, generally I can't trace it directly to the use of that directly to that department like I can my raw materials. So I have to figure out some way, some methodology for getting those IT costs accumulated, and then I have to determine some the allocation basis or some way of then assigning those accumulated IT costs to the manufacturing department. And so that tells me what the true cost of manufacturing whatever product or service I have coming out of that department is, so that I can price accordingly. And that is essentially the gist of what cost allocations are trying to do. And so 3 general guidelines for allocating service department costs include: allocate variable and fixed cost pools separately. Each service department can contain multiple cost pools if more than one cost driver causes the department's costs. At a minimum, there should be a variable cost pool and a fixed cost pool. The variable cost pool should be based on the fixed and variable cost specifications in the department's flexible budget. Secondly, we establish the cost allocation procedure in advance of rendering the service rather than after the fact. So this approach establishes rules of the game so that departments can plan appropriately. And then thirdly, the guideline for allocating service department costs is to evaluate performance using flexible budgets for each service department, just as for each production or operating department. Managers should evaluate the performance of a service department by comparing actual costs with the budget, regardless of how the company allocates these costs. So let's consider an example of a computer department of a university that serves 2 major users, the School of Business and the School of Engineering. And what we're trying to walk through here and understand is that how do we take the cost of that computer department at that university and associate the cost in a fair and equitable way with the School of Business and the School of Engineering with respect to the cost of a 5-year lease on a computer mainframe. Because each of those schools, business and engineering, will use that computer mainframe. Some more, some less, maybe the same, but they'll each access and use that mainframe. So how do we get the cost out of the computer department where it's accumulated into these other cost objectives? And that's what we would call the School of Business or School of Engineering, is the cost objective. So suppose there are 2 major reasons for the allocation: predicting economic effects of the use of the computer and motivating the individuals in the 2 schools to use its capability more fully. How should the university allocate the cost of the computer, which would include things like salaries, depreciation, energy, materials, and so on, to the 2 schools? So to answer this question, we begin by analyzing the cost of the computer department in detail. The primary activity performed is computer processing. The university acquired the computer mainframe on a 5-year lease that is not cancelable unless it pays huge penalties. Resources consumed include processing time, operator time, energy, materials, and building space. Suppose the university performed cost behavior analysis and determined the budget formula for the forthcoming year is $100,000 monthly fixed cost plus 200 variable costs per hour of computer time used. So we see our fixed cost is $100,000 monthly, or $1.2 million a year, and we have also $200 variable costs per hour of computer time used. And that represents all of these resources consumed. And so what we see here is then the general framework for cost allocations. So first we have costs directly traceable to departments. Then we have these indirect costs allocated to departments. And we'll see by arrow 3 that we have service department costs allocated to other service department costs. We have arrow 4, which shows us service department costs allocated to producing departments. Arrow 5 shows us producing department costs allocated to other producing departments. Arrow 6 shows directly traced costs to producing department that an organization can trace directly to products and services. Arrow 7 shows us producing department costs that an organization allocates to products or services. Arrow 8 shows us directly traced costs to service departments that an organization can also trace directly to customers. Arrow 9 shows us service department costs allocated to customers. And finally, arrow 10 shows us product and service costs assigned to customers. And so you can see that when we start talking about how do we accumulate these direct costs in the top box, and we also begin to accumulate these indirect costs in the second from the top purple box, we can see that there are a lot of different sort of places, whether it's products, manufacturing, other service support units. There are a lot of different places that these costs can go. And obviously, part of everything we're doing here is to, we always go back to this cost benefit. So we want to allocate these fairly and equitably so people know what it costs their product, costs to manufacture their product or provide their service. But we have to do that in a way that, and at a cost of doing that makes sense. And so we'll talk a little more about this general framework. So costs in the variable cost pool include energy, operator labor cost, and materials. The cost allocation base for variable cost pool should be a measure of activity within the departments that causes the variable cost. That is the cost driver of the variable cost. In our university example, there's only one such cost driver, actual hours of computer time use. So we'll put all variable costs into one cost pool. The cause and effect relationship is clear. The larger the number of computer time used, or hours of computer time used, the higher the total variable cost. Therefore, the university should calculate variable cost as cost allocation rate per hour times actual hours of computer time used. And so really what we're saying here is that we, with respect to variable costs, we allocate out our pool of costs over some base. And what we're saying is that we want some causal relationship between that base and the amount of cost in the pool associated with the base. So consider the allocation of variable cost to the engineering school when it uses 500 hours of computer time. Suppose the inefficiencies in the computer department cause the variable cost of providing these 500 hours of support to be $120,000 instead of the 500 hours times $200 per hour, which was the budgeted, to get us to the $100,000 of budgeted. So we've got a $20,000 variance there, right? The actual cost ended up causing the variable cost to be $120,000 instead of the $100,000. And so a good cost allocation schema would allocate only the $120,000 to the consuming department and would let the $20,000 remain as an unallocated, unfavorable budget variance of the computer department. This scheme holds computer department managers responsible for the $20,000 variance and reduces the resentment of user managers. And so what we're saying there is that the user managers really had no control over the level of costs incurred by the computer department. So if we allocate the overage of $20,000 to the user departments for increasing their cost and reducing their profitability, or increasing the cost of the product, perhaps impacting the level of sales, then there's going to be a performance issue or a conflict, perhaps because the user department is going to be resentful of the fact that they are now having to absorb the additional $20,000 overage that they had no control over being incurred. And so one good way to do this, and what a lot of companies do, is that they just leave the $20,000 sitting in the originating department. They don't allocate it out, and the manager of the originating department has to be the one who addresses it. So let's consider further the allocation of fixed costs based on predicted usage. This means that the allocation will be based on the long-run capacity available to the user, regardless of actual usage from month to month. The reasoning is that long-range planning regarding the expected required overall level of service, not short-run fluctuations in actual usage, affects the level of fixed costs. And so in this example, suppose the deans had originally predicted the long-run average monthly usage by the School of Business at 210 hours and by the School of Engineering at 490 hours, or a total of 700 hours. These estimates resulted in a committed fixed cost that remained largely uncontrollable over many years. We should allocate the fixed cost pool as we see here, where we have a total of 700 hours expected. The School of Business used 210, or 30% of those 700 hours, based on a $100,000 per month fixed cost we would allocate $30,000 to the business school, and then the same is true of the engineering school. They estimated the 490 hours of usage, or 70% of the 700 hours, and so they would get 70% of the $100,000 per month fixed cost, or $70,000. And so a major strength of using capacity available rather than capacity used when allocating budgeted fixed costs is that actual usage by service departments does not affect the short-run allocations to other user departments. Such a budgeted lump sum approach is more likely to have the desired motivational effects with respect to the ordering of services in both the short term and the long term. And so service departments also often support other service departments in addition to production departments. For example, the IT department may provide IT resources to the production department, but they may also provide IT resources to the accounting department or to the marketing department. And so you have service departments providing support to other service departments that should then have part of their cost allocated to those other service departments, which become a part of that service department's cost, which also then gets allocated out. So there are two popular methods for allocating service department costs to producing departments in such cases: the direct method and the step-down method. And so here we see the processing facility with respect to service department allocations. And so we have facilities management department, which provides facilities management, obviously, the support of the factory space or the office space that's being used. We have the direct cost of 1.2 million square feet of 7,016 employees. So they provide support to the processing department beneath and the assembly department beneath. They also provide support to the human resources department because the human resources department uses facilities. And then we have the same as the human resources department, right? They provide support to processing and assembly because they're hiring staff, they're supporting staff, they're providing human resources support to these staff, but they're doing the same for the facilities management department. And so, we need to determine then what is the right method for how we get costs out of the facilities management department to the processing and assembly department, as well as to the human resource department, and the same is true of the costs in the human resources department. So under the direct method, we ignore other service departments when any given service department's costs are allocated to the revenue-producing or operating departments. The step-down method recognizes that some service departments support the activities in other service departments, as well as those in production departments. And so if we go to our facilities management costs, the direct method allocates these costs to the processing and assembly departments based upon the relative square feet occupied by each of the two departments. So for the total square footage, we have in the producing department is 15,000 plus 3,000 or 18,000. The facilities management costs allocated to the processing department then becomes 15,000 divided by the 18,000 times the 1.2 million, and then the facilities management cost allocated to the assembly department is the 3,000 square feet in the assembly department divided by 18,000 times the 1.2 million to get us to 210,000. And so under the direct method, as we said earlier, it ignores the fact that the facilities management cost is also supporting the human resource department, and it allocates cost to the processing and assembly department only. Likewise, the direct method allocates human resource department costs to the producing departments on the basis of the relative number of employees in the producing department. So we can see again with respect to the total number of employees in the producing department, there are 16 employees in the processing department, and there are 64 employees in the assembly department to give us 80 total employees. And we see we're ignoring the number of employees in the facilities management department. And so we have 80 employees in our producing departments, and so 16/80 times 240 of cost in the HR department creates an allocation of $48,000 to the processing department, and likewise using the same approach based on 64 employees, we're allocating $192,000 worth of cost to the assembly department. And so in contrast, the step-down method it takes into account that some service departments support the activities in other service departments as well as those in producing departments. So to apply the step-down method, we choose a sequence of service department allocations, starting with the service department that renders the greatest service as measured by cost to the greatest number of other service departments. The last service department in the sequence is the one that renders the least service to the least number of other service departments. We allocate the cost of one service department at a time, assigning the cost to the producing department and to the remaining service departments. Once we allocate a department's cost to other departments, we never allocate other service department costs back to it. So it's a one-way flow, essentially getting to this named step down. It's not step down and back up, it's step down. And so we allocate facilities management department costs first because facilities management renders more support to human resources than human resources provides to facilities management. After allocating facilities management costs, we do not allocate any costs back to facilities management, even though human resources does provide some services to facilities management. The $660,000 human resources costs allocated to the producing departments include the amount allocated to human resources from facilities management of $420,000, in addition to the direct human resources department costs of $240,000. So before allocation, the 4 departments incurred costs of $4.1 million. In step 1, we deduct $1.2 million from facilities management and add it to the other 3 departments. You can see there was no net effect on the total cost. The amount allocated to processing is 15 divided by 27 times 1.2 million, or $700,000, and then the amount allocated to assembly was 3 divided by 27 times the $1.2 million, or $140,000. And so what about costs not related to cost drivers? So first we have to identify multiple cost pools, each with its own allocation base. We have to divide the facilities management costs into 2 or more cost pools and use a different cost allocation basis to allocate the cost in each pool via the direct or step-down method. For cost pools with costs that vary with the cost allocation base, the allocation is straightforward. The use of more units of the cost allocation base results in the allocation of more cost. Fixed cost pools are more complex. A company may allocate fixed costs on the basis of long-term cause and effect relationships. While supervisors' salaries may not change immediately, if the department changes the amount of square footage it uses, growth in the size of the department may eventually lead to the need for more supervisors. Remember to use budgeted amount of the cost allocation base, not the actual amount used, to allocate fixed cost. That is, we might use budgeted square footage for allocating supervisor salaries. A fixed cost pool that does not have a plausible or reliable long-term cost driver might remain unallocated. So what we're saying is that we really need to make sure we're comfortable in the end with this cause and effect or causal relationship. So number 2, allocate all costs by the direct or step-down method using the same cost allocation base. In our example, we might choose square footage as the cost allocation base. In this simplified alternative, we implicitly assume that, in the long run, square footage causes all facility management costs, even if we cannot easily identify a short-term causal relationship. So in other words, the need for more square footage may not cause an immediate increase in all facilities management costs, but management may believe that all costs are related to square footage because both cost and amount of space used change as the size of the department changes. And so now we have the traditional approach to cost allocation, which is as follows. We divide the cost in each producing department, including both the direct department costs and all the costs allocated to it, into 2 categories. The direct costs that you can physically trace to the product or service before cost objectives, and the remainder, which are the indirects. Trace the direct cost to the appropriate product or services, and note that some costs that are not direct to the department will be indirect to the department or services. For example, depreciation on the department's equipment. And so again, we're just talking about here how we, what is the approach for allocating cost. And so we talk about this traditional approach where we accumulate the cost in a pool, the indirect cost. I'm sorry, I'll start again. So first we trace all the direct costs we can that are directly consumed, where there's a cost benefit of tracing and maintaining the system and process for identifying direct costs that go to a product. And so suppose a product uses 20 pounds or 2 ounces of gold. Well, that's expensive, and that's probably worth maintaining a process for whereby we trace the amount of gold that goes directly into that product. But suppose it also uses 500 bolts. Well, that may not be something that's as cost beneficial to trace because bolts become a commodity. So bolts may become part of our indirect cost. So we then accumulate all of those indirect costs into a pool, and we decide based on the cost drivers of that pool, how do we allocate them out of that pool? And that is this idea of traditional approach. And so we select our cost pools and related cost allocation bases in each production department and assign all the indirect departmental costs to the appropriate cost pool. For example, you might assign a portion of the indirect departmental cost on the basis of direct labor hours, another portion on the basis of machine hours, and the remainder on the basis of number of parts. Be sure to use separate cost pools for fixed costs and for variable costs. And then finally, we allocate or apply the costs in each cost pool to the products or services in proportion to their usage of the related cost allocation base. Apply variable cost on the basis of the actual amount of the cost allocation base. Apply fixed cost on the basis of the budgeted amount of the cost allocation base. And so if we look at this example, we're applying the cost in each cost pool to the products or services in proportion to their usage of the related cost allocation base. We apply the variable cost on the basis of the actual amount of the cost allocation base. We apply the fixed cost on the basis of the budgeted amount of the cost allocation base. And so here you can see, using this traditional approach with the step-down method, we've taken the facilities department cost of $1.2 million and we've allocated a portion of it to the human resources department, again based on square footage, and we've allocated a portion of it to both the processing department and the assembly department. Then we've also included an allocation from the human resources department that includes what was allocated from facilities management plus the direct cost of the human resource department, and allocated that based on personnel, not square footage, but based on personnel, to the processing department and to the assembly department. But you can see what we haven't done is to allocate anything back up from human resources department to the facilities management department, even though there are human resources efforts associated with the facilities management department. And then you can see, as we've allocated each of these service departments, facilities management and human resources department, you can see the cost impact in the processing department and in the assembly department. So another way to do this is through activity-based costing. And to apply activity-based costing, or ABC, we use the following 3 steps. We determine the key components of the system and the relationship among them. We collect the relevant data concerning cost and the physical flow of the cost allocation base units among resources and activities. And then we calculate and interpret the new ABC information. And so this just provides us with a picture of the activity-based costing model and what it would look like if we had said, well, for facilities management is one set of activities, and that we can see that it results in this FM tab, and which also goes into the human resources department. And then human resources department's output or allocation includes the HR tab. And then if we look at now we split this up, and so instead of processing and assembly like we had before, we have engineers and CAD equipment, we have machine tools and mechanics, and we have supervisors and equipment. So we have new cost drivers associated with these pools, And we can see that, well, based on these new cost drivers in these new pools, we have a certain amount coming in from facilities management and HR. So customer profitability depends on the cost incurred to fulfill customer orders and to provide other customer services such as order changes, returns, and expedited scheduling or delivery. So we look at customer type 1, we see that this customer, as an example, buys a mix of products that have high gross margins, yielding a high gross margin percentage of about 70%. Customer type 1 also has a low cost to serve percentage, which is cost to serve to sales revenue of about 30%. As a result, customer type 1 will have a high level of profitability. That's 70% gross margin minus the 30% cost to serve to get us to a 40% gross margin. On the other hand, customer type 2 buys 2 products with a low gross margin and is very costly to serve, resulting in a loss to the company of about minus 15%. Most of this difference represents the 35% higher cost to serve. And so this gives us an idea of the list or profile of low and high cost to serve customers. So with customer type 1, we have low cost to serve, large order quantity, fewer order changes, little pre and post sales support, regular scheduling, standard delivery, and few returns. So we can see that those all collectively would result in a lower cost to serve versus customer type 2, which has small order quantity, so perhaps there are multiple setups. Many order changes, so perhaps there are a lot of specific custom changes. Large amounts of pre and post sales support. Maybe it just takes a lot to keep our customer relationship with this customer. Expedited scheduling, which costs us additional money to put their products ahead of others. Again, setups and tooling cost, special delivery requirements, and frequent returns. So you can see how these types of issues combined would result in different costs to serve for each of the clients. And so customer profitability depends on more than the gross margin of the products or the services produced. It also depends on the cost incurred to fulfill customer orders and to provide other customer service such as order changes, returns, and expedited delivery scheduling. And here we just see that we charted or graphed where these particular customers fall on with respect to gross margin percentage and cost to serve percentage. So, Cedar City Distributors, or CCD, is a distributor of athletic apparel and sports gear. CCD distributes many products to retail outlets but classifies products into just 2 product groups, apparel and sports gear. They have 2 types of customers: small stores that order low volumes, the majority being apparel, and large stores that order large volumes of both apparel and sports gear. And so CCD currently uses a simple cost accounting system to allocate both product and customer profitability. The only direct costs are the purchase costs of apparel and sports gear products. CCD allocates indirect costs to the product groups using a single indirect cost pool for all indirect costs with an actual pounds of product as the cost allocation base. Although it is preferable to allocate variable and fixed costs separately, each with its own cost allocation base, it's not unusual for companies to use a simpler system that combines all indirect costs in a department into one cost pool. If most indirect costs are variable and vary with changes in the cost allocation base, this is a reasonable simplification. We'll see later it is reasonable for CCD. And so, to determine the profitability of a customer, we first calculate the profit margin per case for each product. Then we use the product mix ordered by each customer to calculate profitability. Based on the profit margin percentage, apparel products are more profitable than sports gear, since small stores' product mix is 75% apparel compared to only 50% for large stores. We expect small store customers will have a larger profit margin percentage. The refined cost allocation system significantly changes the profitability measures of small and large stores. Contrary to the results based on the simple existing cost allocation system, the refined system shows that large stores are the most profitable customers. In our refined system, we allocate $276,000 to the customer cost objectives on the basis of number of orders, an allocation base that represents the cost of the cost much better than does pounds of product. And so here we see the profit margin per case for each product. And so here we see customer profitability is based solely on the product mix ordered by a particular customer. It is plausible that all of the activities and associated indirect costs included in the indirect cost pool are related solely to the weight of purchased products. Is that true? So might the number of customer orders be a more plausible cost allocation base for some items like the order processing and customer service activities and related resources? Let's assume the number of orders was indeed a better cost driver allocation for the order processing and customer service activities. And so here we see the same graph we saw earlier, and after we've refined the cost allocation base. So many managers believe it is desirable to fully allocate all of the organization's costs, including central corporate support costs, to the revenue-producing or operating parts of the companies. Such allocations are not necessary from a financial accounting viewpoint and usually not useful as management information. For this reason, we do not consider central costs to be a part of the value chain in this text, and we generally recommend that companies not allocate these costs. However, if a company chooses to allocate central support costs, it is important to allocate them in a way that managers accept as fair. It's very often difficult to find a good measure of the usage of central services, but some companies find measures that managers believe are fair, such as usage, either actual or estimated. As a result, some companies use cost allocation bases such as the revenue of each division, the cost of goods sold by each division, the total assets of each division, or the total cost of each division before allocation of the central cost to allocate central costs, even though these bases are not necessarily the cost drivers. And so the issue here becomes one of, well, it's neither right or wrong to allocate your corporate cost or your central cost, right? The issue becomes whether or not there's cost benefit that's necessary or appropriate. Does the cost benefit support the allocation of these? After allocation, do we get a better picture of the organization's profitabilities that they're allocated to? And also, have we addressed this sense of equity and fairness to the managers that these costs are getting allocated to, in light of the fact that generally they have no input over the level or the amount of these general central support costs and how much are incurred and what they're incurred for. So there are a lot of political, organizational, HR issues that go into this decision. But again, there's no right or wrong answer to it. Each organization comes up with its own solution to this problem. So we see also that companies routinely allocate joint product costs to products for purposes of inventory valuation and income determination. So we illustrate two methods of allocation. There are two conventional ways of allocating joint costs to products: the physical units or the relative sales value. Joint costs include all inputs of material, labor, and overhead costs that are incurred before the split-off point. Companies routinely allocate joint product costs to products for purposes of inventory valuation and income determination. And as we said earlier, there are two conventional ways of allocating joint costs to products, either physical units or relative sales value. The physical units method requires a common physical unit for measuring the output of each product. The joint costs are allocated based on each product's percentage of the total physical units produced. Allocation of joint costs should not affect decisions about the individual products. And so this is an example. Here we have an example of the Dow Chemical and allocating joint costs using the physical units method. So Dow Chemical produces two products, X and Y. The joint cost is $100,000 times. The joint cost is $100,000. X sells for 9 cents per liter and Y for 6 cents per liter. Because 2/3 of the liters produced are chemical X, we allocate 2/3 of the joint cost to X. Likewise, 1/3 of the liters are chemical Y, so we allocate 1/3 of the cost to Y. And so we can see in the bottom caption how joint costs are allocated. And again, it's based on the proportion of the product of X and Y to the total units produced, and then that's the joint cost is allocated based on that proportional breakout. The physical unit method requires a common physical unit for measuring the output of each product. For example, board feet is a common unit for allocating the cost of logs to a variety of products in the lumber industry. However, sometimes common physical unit is lacking. And so where that's the case, we can also use the relative sales value method when we cannot sell one or more of the joint products at a split-off point. Here, the weighting is based on the sales value of the individual products. Because the sales value of X at the split-off point is $90,000 and the total sales value at the split-off point is $120,000, we allocate 90. 1/20th of the joint product cost to X. And so again, here we're under the relative sales value. We're not using a physical units determinant of allocating the joint product cost. We're using the relative sales value. Byproducts are similar to joint products. A byproduct is a product that, like a joint product, is not individually identifiable until manufacturing reaches a split-off point. Byproducts differ from joint products because they have relatively insignificant total sales value in comparison with the other products emerging at split-off. In contrast, joint products have relatively significant total sales values at split-off in comparison with the other jointly produced items. And so finally, if we account for an item as a byproduct, we allocate only separable costs to it. We allocate all joint costs to the main products, and we deduct any revenues from byproducts less their separable costs from the cost of the main products. And so this completes Chapter 12. And as I noted early on, and as I'm sure it's become apparent during the presentation, that this is a complex area, but it is an important area because it really does impact the profitability of an organization at the unit level. It may impact unit level managers' performance evaluation. It may impact their compensation decisions. And so because indirect costs are such a large part of the total cost of an organization, it becomes really important to understand and to be very knowledgeable and conversive about, how are they treated, how are they allocated, if they aren't allocated, why aren't they allocated, if they are, what's the basis, what are the pros and cons of one basis over another. And so you can see it becomes fairly complex. And so it's an important chapter. I encourage you to please go back and read it and reread it until you feel comfortable with this. Don't let this presentation by any means serve as the only way you're getting exposed to the material in this chapter. And then please move on to the discussion forums and the learning exercises. And thanks very much for your time today.